Did you know the silver price gap between China and the US just hit $3.50 per ounce? That's a 5-year high. This isn't random, it's a flashing warning sign. The dollar's dominance is cracking, and economic warfare is escalating. This matters now because it could trigger a dollar collapse, reshape global trade, and wipe out unprepared investors. Your portfolio is at risk. In this video, you'll learn how silver arbitrage works. It's simpler than you think. Why China and the US are locked in this silent war, how to protect your investments. And the shocking truth, this arbitrage gap is being weaponized, and 97% of investors won't see it coming. Quick reminder, this video is educational only, not financial advice. Investing involves risks. Consult a professional before making decisions. Arbitrage means buying low in one market and selling high in another. For silver, it's about exploiting price differences between China, Shanghai Gold Exchange, and the US, COMEX. Step 1. Spot the gap. Check real-time prices. Example, if COMEX silver is $25 Oz and Shanghai is $28.50 Oz, the gap is $3.50. Step 2. Buy low, sell high. Buy physical silver in the US, ship it to China, and sell it. Why silver? It's small, portable, and critical for tech and green energy. Unlike gold, it's industrial, so demand shocks matter. Think of it like buying iPhones in the US and reselling them in Brazil where prices are higher. But here, silver is the product, and geopolitics are the border tax. Historically, arbitrage gaps lasted days. Now, they're persistent. What changed? Cause: US sanctions on Chinese banks. Mechanism: capital controls trap Chinese capital. Investors in China can't easily buy US silver, so they bid up local prices. Impact: a two-tier market. US exporters lose access, while Chinese consumers pay premiums. Data example, in 2023, gaps averaged $1.80. Today, it's $3.50 plus. Why? China's central bank bought 120 plus tons of silver this year, 20% more than 2023. Analogy: imagine two identical houses on opposite sides of a river. A broken bridge, sanctions, forces one side to pay 30% more. Prices won't equalize until the bridge is fixed. This isn't just trade, it's economic warfare. Cause: US weaponizes the dollar via sanctions. Mechanism: China retaliates by stockpiling silver for tech dominance, for example, solar panels. Less dollar demand, downward pressure on the dollar. Impact: a weaker dollar makes commodities, like silver, cheaper globally, but also inflames tensions. Macro trends: rising US debt, $34 trillion plus, erodes dollar trust. Inflation: US CPI at 3.4% pushes investors to silver as a hedge. China's yuan devaluation, down 5% this year, fuels local silver demand. Risk spotlight: if the dollar falls 10%, silver gaps could widen to $5. Winners: Chinese stockpilers. Losers: US retailers. Winners: Chinese industrial users pay less for silver locally. Global arbitrageurs with logistics access. Losers: US manufacturers pay 15% more for imported silver. Retail investors face higher prices and volatility. Cause and effect: cause: sanctions disrupt supply chains. Effect: higher silver costs, pricier electronics and EVs. Bigger picture: this mirrors 1970s oil embargoes. Back then, it was oil. Today, it's silver, and it's quieter, deadlier, and digital. Volatility: gaps can vanish overnight if sanctions ease. Leverage risk: borrowing to arbitrage amplifies losses. Example: a 10% price swing could wipe out 30% of your capital. Liquidity trap: in a crash, you might not find buyers in China. Counterparty risk: your Chinese buyer could default. Regulatory risk: new US tariffs could kill arbitrage. Timing risk: shipping delays, for example, port strikes, can reverse profits. Macro risk: if the Fed cuts rates, the dollar weakens further, making gaps wider but riskier. Action steps: track gaps daily, use kitco.com or TradingView for real-time US-China silver prices. Review exposure: if you hold silver ETFs, check if they hold physical or futures. Physical is safer. Set risk limits: never risk more than 5% of your portfolio on arbitrage. Diversify: hedge with miners, for example, First Majestic or silver futures. What to watch: US-China relations, trade talk, sanctions, dollar index, DXY. If it drops below 100, gaps widen. Fed rate decisions, cuts boost silver. Chinese silver imports, Shanghai exchange data, inflation reports, US CPI. Geopolitical events, for example, Taiwan tensions. Silver arbitrage gaps are at 5-year highs, fueled by US-China sanctions and dollar weakness. This isn't just trade, it's economic warfare. Winners: China's stockpilers. Losers: US manufacturers. Track DXY, CPI, and sanctions headlines. Final risk reminder. Arbitrage is high risk, not for beginners. Past performance not equal to future results. If this helped, subscribe for more. Comment below, what silver indicators are you tracking? Stay vigilant.